Good evening and welcome to Understanding Student Loans. I am your host and presenter this evening, Erin Mack, and I'm one of your financial aid advisors here at St. Edward's University. We're going to go ahead and get started, and if you have any questions, we'll get contact information for your financial aid advising staff towards the close of the presentation. I'm going to take myself off video so I can focus better on the presentation. Here we go. Thank you for being here. So understanding student loans, what we'll cover this evening is navigating the student loan process from borrowing to repayment. So first thing we're going to go over is the players in student loan lending. The borrower is the person who signs the MPN or the master promissory note. They are the person who agrees to repay the loan based on the terms of the promissory note. Ultimately, they are the one responsible for the loan being repaid. The lender is the company or the entity that provides the funds. They own the debt. Ultimately, they are the ones who are repaid that debt, that loan. A servicer is a very important contact party in this whole arrangement. The servicer manages the communication in between the borrower and the lender. They are the ones to whom the borrower makes payments. They're the ones to whom the borrower would call to change a payment arrangement, to make any adjustments to the loan, change repayment plans. They're an important operative here. The school is the university that confirms the student is eligible to borrow by virtue of they being in good academic standing, that they're being a student enrolled in the appropriate number of hours. And for credit-based loans, the school also sets the borrowing limit based on guidance from the federal regulations. The guarantor, in some credit-based loans, the lender will require the borrower to have a guarantor to provide financial backing for the loan. Guarantor is also another name for a cosigner or an endorser. And finally, this acronym NSLDS. This stands for National Student Loan Database System. This is a list of all the borrower's federal loans, the interest rate for each of those loans, and who the loan servicer is and how to contact them. So this is a hub of information that is updated every 30 days from the school, from the borrower, from the loan servicer. Any information about your loans will be held in there. Your financial aid office has access to see it, as well as, of course, the borrower does. So let's go over in some key points. So in this presentation, I'm going over our most frequently asked questions. It is not the end-all be-all loan educational module, but it gives you, like I said, most frequently asked questions. So the borrower, our students, will typically be offered 2 loans on their financial aid award: the direct loan subsidized and direct loan unsubsidized. Both of those are a mouthful, so we typically refer to them as the sub and the unsub. For this presentation, I'll try to keep it with direct loan sub. So for the sub, a FAFSA is required. The borrower must submit a FAFSA to be considered for the subsidized loan, because we need to determine if they have sufficient financial need to borrow this particular loan. The student must be enrolled in at least 6 credit hours per semester. There is no credit check or cosigner for this direct loan sub. And this is the one that does not accrue interest while the student is enrolled and in their grace period. And we'll go into a little bit more detail about those 2 points later. The sub or the direct loan sub loan does have annual borrowing limits. As a freshman, which is a student with less than 30 credit hours, they can borrow up to $3,500 in a sub loan. As a sophomore, which is 30 to 59 credit hours, the student can borrow up to $4,500. Again, this is per academic year. And as a junior and senior, which is someone with more than 60 hours, they would have no more than $5,500. So that's the overview of the sub. So let's go to the direct loan unsub. Again, the FAFSA is required. However, no financial need is required. So this one is eligible for really any student. They also must be enrolled in at least 6 credit hours per semester that they receive the loan. And also there is no credit check or cosigner required. So an undergraduate student working on their bachelor's degree, borrowing a direct loan unsub, can have up to $2,000 per academic year. The only way that we can increase this is if the parent, if this is a dependent student for financial aid purposes, and the parent plus loan is denied, then we're authorized to bump up the unsub loan to some graduated amounts. Graduate students are also eligible to borrow the direct loan unsub. Grad students can borrow up to $20,500 per academic year. And then the other type of federal loan program is a direct plus loan. So a direct plus loan is credit approval required. Sometimes if the borrower is not approved, they will ask for an endorser, which is another word for a cosigner or a guarantor. No financial need is required, but the student must submit a FAFSA, whether that is a graduate student applying for a graduate plus loan or a parent applying for a parent plus loan, their student must submit a FAFSA. And for these plus loans, the school or the university sets a borrowing limit based on the cost of attendance. Cost of attendance being essentially a budget. Cost of attendance really makes it sound like that's how much you're going to pay, but it's really more of a budget number. It includes tuition, required fees, an allowance for living expenses on either on or off campus, books, and that kind of thing. So let's go on to look at some of the more financial details of each loan. So these are broken down a little bit differently. I've organized this by who's borrowing the loan. So for an undergraduate student, undergraduate students can borrow the direct sub or unsub loans. The interest rate for this current academic year is 2.75%, and that is fixed. These loans will have their interest rate reevaluated at the beginning of every fiscal year. So around July 1st, we'll find out what the interest rate is going to be for the 21-22 academic year. There is a 6-month grace period. So that means between the time the student graduates or ceases enrollment, they have a 6-month period before the loan must be repaid. The repayment terms, it's a minimum monthly payment of $50 per loan for 10 to 25 years. So if you borrowed a subsidized loan every year for 4 years, you have 4 sub loans. So at the very least, you'll pay $50 per loan, but we'll get into repayments a little bit. I'm not going to get too deep into that. And that is the same for the undergraduates sub and unsub loans. So a graduate student is eligible to borrow a direct unsub loan. Remember, this is the one that accrues interest from the time the first loan portion gets dispersed. So for a graduate student, the unsub loan has an interest rate of 4.3% fixed. Again, this interest rate is going to change every year, but the loan borrowed in a particular year will not change. There is also a 6-month grace period for the grad student's unsub loan, and a minimum monthly payment is the same as the sub. So if you are a graduate student or the parent of an undergraduate student, you are eligible to apply for a direct plus loan. This is the credit-based loan. The interest accrues from the time the first loan amount disperses. The interest rate for the current academic year is 5.3 fixed. Again, this is going to get a different interest rate as of July 1st. So each academic year, the interest rate is going to change, but the loan remains fixed based on the year it was borrowed. And again, 6-month grace period and the same repayment terms. So minimum $50 per loan for anywhere between 10 and 25 years. There are other types of loans that we can connect students with. None of these go through the university. We are not a lending institution, but we can provide information and give you information to help you make a good decision that's right for you. So the college access loan, this is available for Texas residents only. And they have a specific definition of what makes a Texas resident. So a Texas resident, and this would apply to the borrower, must have graduated from a high school in Texas. And prior to graduating from high school, they must have attended that or a Texas high school for 36 months prior. So essentially, if you did all your high school years in Texas, you're okay. The interest rate for this academic year is 4.2%. Again, like the other ones, it's going to get reevaluated for the next academic year, but its interest rate is fixed based on the year borrowed. So the amount you borrowed in that year will always have that same interest rate. And it also has a 6-month grace period and minimum monthly payment of $50 for 10 to 20 years per loan. There are also private loans. While we don't recommend one over the other because these are all credit-based, and the student must meet the terms of the loan, or 9 times out of 10 they're going to have a cosigner unless they're over 21, adult, have a credit history, and the interest rates are vary wildly. So it's just, if you have a relationship with a lender, your bank or credit union might have a private loan product. Going back to the college access loan, I just remembered, the student will need a cosigner for the college access loan if the student is under 21 and does not have a credit score of 650 or higher. So they do publish their approval criteria on their website. Your financial aid advisor at St. Edward's can email you this, so you'll have access to it. We do have certain private loan lenders listed on our website. We don't, again, endorse one over the other, but it's just a way for you guys to see some options of who our students have used in the past. So let's talk a little bit about repayment. So probably the single most informative move that you can make, more so than sitting down with your financial aid advisor, is completing the exit loan counseling. The reason this is so important is because it's your window to understand your own student loan debt and repayment options, and really taking ownership of that whole process. Now, we are available and more than happy to answer your questions, help make sure that you are understanding what you think you're understanding. But going through this first is really important, just so you get familiar and you have a better, just have a better primer. So this is so important, in fact, that Department of Education requires, that schools require that you fill it out and that you complete it. So if you are graduating or you have recently graduated, you must complete the exit counseling before you're allowed to have your diploma released. Yes, just like it says there. You log into your exit loan counseling portal using your Federal Student Aid ID, your FSA ID. That way you will see your individual loan debt. This is not a hypothetical. You're going to see your loan debt, the repayment plans. If you pick the standard, what is that going to look like monthly? What is your interest going to be? So you can figure out which one is a better fit for you. And if ever you want to change your repayment plan over time, you can contact your loan servicer and they will make that change for you, or help you figure out which one is best. There is a loan simulator in the exit loan counseling that will help you figure out what the monthly payment will be based on the different repayment plans. So it's really, really important. And it's a powerful tool to help you feel that you're informed and educated, and help you make a good decision. So the grace period, I mentioned that earlier when we were going through the different types of loans. So grace period is a period of time after graduation, or if you drop below 6 hours enrollment, even if you're in 3 hours, you're in your grace period. If you withdraw from a semester, you're technically in your grace period till you return. So after you drop below required hours and before you actually start repaying. The grace period of 6 months for the direct loan sub or unsub, and it is optional for the graduate or parent plus. This is a good time to mention that there's never a penalty for paying your loan off early, but this is just when you must begin repaying it. For the sub loan, the direct loan subsidized that I mentioned, there is no interest accruing while you're enrolled. It starts after your grace period and continues until it's paid in full. Again, no penalty for early payoff. And here is a resource at studentaid.gov to find out specifics about grace, a lot more detail. And I'll give you these websites towards the end so you can take a picture or save it. So what happens if you're having trouble making your loan payments? The best thing you can do, without question, is to contact your loan servicer and say, I'm having trouble making payments. Is there anything that we can do? Let me tell you my situation. The worst thing you can possibly do is ignore it and go, can't pay that now, which that's never a good idea for any of your bills. Not a good idea for your car payment or your utility bill, but for your student loans, it can have really some very serious consequences if you let that get out of control and you just forget that it's there. So contacting your loan servicer, this is the company to whom you're making payments or you're supposed to start making payments. Right now, if you're in school at least 6 hours a semester, you are considered to be in deferment. You're not required to make loan payments while you're enrolled. So there are other ways that you can qualify for a suspension of loan payments or a reduction of loan payments. It's called forbearance or other types of deferment. These are very similar, but it changes either, sometimes it might just suspend your payments for, a month or 3 months or 6 months till you get back on your feet. If you lost your job, if you're having some health issues and you're not working or just, have some other priorities that are really pending. So again, contact your loan servicer to get, and this is temporary and the interest keeps going, some help if you're in hardship. So consolidation. So this refers back to one of those earlier slides with the yellow background that said your repayment is at minimum $50 per month per loan for 10 to 25 years. So if you took out a sub loan every year for 4 years, you have 4 loans. So at $50 a month, that's $200 a month. Now let's add to that 4 unsub loans. Well, now we're up to $400 a month. And this for a student that might be really tough on your budget. So one of the things that you can do is stretch out that repayment plan from the base 10 years to something up to 25 years. One of the ways you do that is by consolidating, which means you take your 8 small loans and combine them into one single larger loan. It locks in the interest rate for the whole repayment period by averaging or giving a weighted average based on the annual interest rates for each of those loans you took out. So lengthening your repayment period does give you a lower monthly payment, which in the short term might be just what you need. But overall, over the life of the repayment, you will end up paying more interest, which is ultimately going to cost you more. And it's just a fee, the less interest, the better. But, you will have a single monthly payment rather than your payment divvying up into smaller loans, smaller monthly payments onto different loans. With consolidation, an alternative or a private loan, such as a college access loan or a bank loan, cannot be consolidated with your federal loans. Those will always stand alone. So consolidation can be a benefit, but you can look at different loan calculators and see how it would work out for you. So a little bit about budgeting. So how much can you afford to pay when you're looking at your exit loan counseling and you're looking at the different repayment plan options, which I believe right now there are 8 different repayment plan options, all with varying monthly amounts. So you want to pay as much as you can. So it's done. Your debt is resolved and you've paid it. So start with your income. You want to, starting with a budget. This is a quick tutorial on how to make a budget. Write down everything you spend, putting it into categories: rent or mortgage, utilities, lights, water, gas, trash, food, auto payment, auto insurance, clothing, entertainment, medical bills that you may have recurring. Savings should be on your budget, and maybe other types of loans. So these are just some of the categories you may use. I also have a pets category in my budget. Review and adjust it monthly. If you find that you can save some money on clothing, maybe you could put that extra money into savings or pay, another $15 on your student loan. It adds up. It really does. Think of your budget as every dollar having a job. In a perfect budget, your income equals your expenses, meaning that you don't spend every penny you have. It means, but it has a job, whether that means your savings account is one of your expenses. So if you have extra money, put it in savings or pay off debt. If your income is more than your expenses, you can save more or pay off debt. If your income is less than expenses, really your only option is to decrease your spending or increase your income. Both require you to make, sometimes tough choices, but important ones as well. So moving into forgiveness and discharge of your loan. So this is something we get a lot of questions about. I want to go into discharge first, even though it's second on here, because it's usually something, yes, your loans can be discharged or canceled based on very extreme circumstances that, quite frankly, you probably don't really want to have. Discharge means your loan you're no longer required to make payments. It's not zeroed out, but you're done making payments on it. That would happen if you have a total and permanent disability, if the school where you are enrolled and attending and receiving your loans closes, or in the death of a student. And that would be true for the student loans as well as a parent plus loan taken out in the student's name. Forgiveness is a hot topic. Forgiveness means part of your loan debt is zeroed out. You owe less money now. There's essentially 3 types of loan forgiveness. One that's gotten a lot of press in the last few years is called public service. If you work for a qualifying employer, meaning a nonprofit or a city, county, state, federal government entity, essentially you consolidate, you pay for 10 years, and after 120 on time in full payments, the balance is forgiven. This has been a bit of a mess for the last trying to get this organized and documented. So I know Department of Education is working on it, but it's not full steam ahead on this one yet. The teacher forgiveness, it's a reduction of the loan debt after a certain number of years working in a qualifying school district and in a particular specialty. There's also income-driven plans. These are not tied to your employee, they're actually tied to your income. So if you choose an income-driven plan, which is, I think there are 4 or 5 of the different repayment options that are tied to your income, meaning that you pay a percentage of your income. And if you have a lower than average income, you might pay very little, but you have to show proof of income with a tax return every year. So they make sure you stay, you're paying what you can. After 25 years, then that balance is forgiven if you have any left. So that means you're paying on your loan for 25 years. You might not pay the debt in all. And the idea is that it fits within your budget if you're on a more limited budget. A lot of information about this on studentaid.gov. So definitely check that out if you're curious interested in more information. And here are all of the websites that I used in pulling this data. So almost everything is at studentaid.gov because that is the Department of Education's federal student loan aid website. So it's the end all be all of information. Another wonderful source of information is your loan servicer. So their job and their role is to, accept payment for your loan debt, but also make sure that if you're having any issues, it's being handled. So they are supposed to be your communication, your contact, your resource. So, allow them to do that. And if you're a St. Ed student, of course, we are more than happy to help you in the way that we can. We typically can't, make phone calls on your behalf, but we can advise you. We can help, make sure that you're understanding, what you're reading. And you just be an advisor as we can. So I'll leave this up for a little bit longer. You guys can take a picture of it, or just studentaid.gov is really what you is your takeaway here. And there's a website and a link for the National Student Loan Database. You will need your FSA ID, the same username and password that you used to sign the FAFSA. You'll need that to log in so you can see your individual loan debt. Here is your financial aid advising staff at St. Edward's. We've all been to college. We've all had our own experience with using federal student aid. Of course, we advise students every day, all day. We love what we do, and we enjoy getting a chance to help you guys out in any way we can. So the best way to reach us is by email. Through email, we can help you set up an appointment for us, and you can always reach us by phone as well. So here is where to contact us. We are on campus. We're in the main building, room 204. We have a virtual front desk if you'd rather meet us online. That someone is always working our virtual front desk Monday through Friday, 9 to noon. You can talk to a person. If you'd like to reach us by phone, our phone number is there. Also email, if it's not particularly time sensitive, or you just need to or you're not sure who to ask, just send an email there or go to our virtual front desk and we can make sure the right person reaches out to you. And there's our website. And sort of if you would like to come and visit on campus, you can sign up for a campus visit there. And I think that brings us to the conclusion of our webinar today. And I appreciate you for listening, and certainly know that you can always reach out to anyone in our office with any types of questions that you have. I do hope this answered some of your questions, but it may have left some unanswered. And please feel free to provide us some feedback, because we can always improve our presentations based on your responses. So thank you very much and have a great evening.